Welcome to Deep Market Insights, where we go beyond the headlines to uncover the market's hidden currents. I'm your host, and each episode we decode not just what happened, but why it matters, and where the smart money is really moving. Let's start with the market snapshot. The Sensex closing at 78,580 and Nifty at 23,850 looks like a panic move. But is it really just sentiment?
Not entirely. If you dig deeper, you'll notice FII sold about 2,900 crores, but DIIs quietly bought 2,150 crores. It's almost a handoff of power. The market is telling us foreign exits are no longer dictating direction, domestic flows are becoming the cushion. That's a fundamental structural change in Indian equities.
Interesting. And while everyone's blaming Trump's new tariffs, isn't it odd how that became the convenient scapegoat?
Exactly. The tariffs were noise. What mattered more was the nervousness around global growth. But here's the twist. Historically, whenever India decoupled from global pessimism, that's when multi-year bull runs started. The fact that DIIs stepped in today is a very bullish undertone no one's talking about.
Let's shift to policy. SEBI just announced tighter rules on algo trading. People see this as a clampdown, but is it deeper than that?
Yes, much deeper. This is SEBI signaling that the era of unchecked high-frequency algo dominance is ending. They're pushing for transparency and leveling the playing field. If you think back, such structural shifts create new winners: brokers with compliance strength, fintech players building AI-led execution, and retail platforms adapting quickly.
Now, the rupee touched 84.9 against the dollar today. Many investors see that as weakness. Should they?
Weakness on the surface, yes. But look closer. This isn't just about a strong dollar. It's about India's import-heavy structure and rising crude. The real risk isn't today's 84.9. It's whether the RBI continues burning reserves to defend 85. If they let go, exporters, IT and pharma will see a tailwind. So currency is quietly setting up the next rotation trade.
Speaking of rotations, earnings season has kicked off. What stood out to you?
FMCG numbers surprised me. Despite inflationary pressures, volume growth picked up, which means rural demand is slowly reviving. Contrast that with IT, where margins remain under stress, but order books are strong. Smart investors aren't looking at just the quarterly blips. They're spotting the sectors where demand recovery is secular. FMCG and select manufacturing names are quietly setting the stage.
So if we zoom out, today looks like panic selling, but in reality, it's a market in transition. DIIs absorbing FIIs, SEBI reshaping the rules, the rupee hinting at rotations, and earnings quietly signaling consumption strength.
Exactly. Today wasn't weakness, it was redistribution. Smart money loves these days because it's when long-term positions are built under the cover of bad headlines.
That wraps up today's Deep Market Insights. What looked like a day of panic actually revealed a system in transition. DIIs taking the driver's seat, SEBI tightening the rules, the rupee facing structural challenges, and earnings showing us where consumption is really heading.
Exactly. Stay contrarian, stay informed, stay profitable.
Thanks for tuning in. We'll be back with more insights that dig deeper than the ticker tape. Until then, trade smart, invest wise, and keep questioning the obvious.